Hello and welcome to Moneylife. This is Sucheta Dalal. This week, let's talk about something that involves all of us. If you are an investor in the market, what kind of protection would you like from the regulator? Now, the issue is simple. When aiming to protect investors by eliminating fraudsters, what approach should the regulator take? Should the focus be on eliminating the crooks and going after them? Or do you think it should be on imposing additional regulations and tracking requirements and compliances on those who are already legal, registered financial intermediaries attempting to run a clean business? The answer would be obvious to you and me, right? Not to the Securities and Exchange Board of India. So on 31st Jan, SEBI released a consultation paper calling for feedback on a provision that it has come up with to protect investors. It seems very simple and efficient and a way to safeguard investor interests. And that's how all new regulations come about. They're for your own good. They're helping protect you. But what they do is add yet another layer of compliances, which makes people not want to be registered legal entities. So here's what SEBI's consultation paper has said. I'm showing you the link. It is creating a special UPI, Unified Payment Interface-based system, which will help investors identify registered market intermediaries. How is it going to do that? This special UPI, depending on whether you're making a SIP for a mutual fund or dealing with a bank DP or a broker, will have a special suffix. So it'll pay right, maybe the name of the bank name, or it'll be ABC.BRK representing the broker, or say XYZ mutual fund, which will have XYZ.MF. That's not all. Once you make the payment, you will get a green thumbs up to say, this is a registered entity and you have made the payment to a registered entity. And you're going to be very happy. Now, SEBI has analyzed a lot of data and said that by and large, transactions per day are not more than 2 lakhs. So UPI limit of 2 lakhs should suffice. At the most, may go to 5 lakhs. All very good, right? The consultation paper then goes on to specify roles and responsibilities for SEBI registered intermediaries, how they should register, what they do with existing UPI payments, because from 2019, you can pay by UPI. So all those will disappear over a period of time, merge into this one special UPI. And of course, there's no talk about what happens to existing payments. So if you already make SIP payments, then you probably have a direct debit from your bank. Probably make your transfers to your brokerage directly from your bank, especially if you're with an online brokerage firm. So in any case, people who operate through UPI or who will use this special UPI will be a small subset of the number of people in the market. The consultation paper doesn't show how much they are because there is this grand new idea of saving people. So if SEBI's intention is to offer the special UPI as an optional safety measure for those who want it, there's no issue. It's almost like Twitter's blue tick, right? So it was verifying individuals who were supposed to be important until it became X, and under Elon Musk, you have to pay for it. So it has no meaning, but it's there. If you want to be ticked and verified and you pay for it, it's an option. If this is what is planned, no problem. On the other hand, if SEBI wants to make it mandatory for registered intermediaries, as seems to come out from the consultation paper, then it's a different matter altogether. For starters, it misses the entire psychographics of why investors go to unregistered illegal entities in the first place. Barring a few who fall for cloned websites and where they think they're dealing with a registered intermediary, which is created by cyber criminals, the vast majority look at WhatsApp and social media posts from their friends, family, people in the building, and they go to a person for one simple reason: greed or fear of missing out. Because somebody in the group is saying, I got a 100% return, I got a 50% return, I bought this stock at 20, it's gone to 200. That is why you say, who's done this for you? And you go to that broker. You are too lazy to do basic homework. In fact, a combination of these factors and mindless risk-taking plays a role. Let me give you an example. We personally know of a Mumbai-based surgeon who's so into the market that he has done 3 levels of certification from the National Institute of Securities Management, fully familiar with SEBI registration requirements, and yet knowingly invested with an unregistered Surat-based firm offering a portfolio management service and lost money. Now, there's only one reason he would have done it, because that PMS was probably offering very high returns and vanished. Now, let's come to 32. If you are a regular reader of Moneylife, this blog has come a little later, and you've been watching these blogs from the beginning, you will know the extensive detail in which we have covered 32 broker defaults on the National Stock Exchange. They've stopped in the last year or two, but after the pandemic, it was regular. All these were SEBI registered intermediaries. Investors have not lost small money. It's in thousands of crores. In fact, one Carvi alone is nearly 2,000 crores. They were cheated by registered intermediaries. So that registration alone is no protection. So green thumbs up to make the right payment is no protection. SEBI has to do much more. These guys were running illegal PMS services, and people were giving money to brokers who were running illegal PMS services. So being a registered entity is not a solution. Third, SEBI has this long list of investigations. If you follow the market, almost every day it's imposing penalties or entering into settlements, covering front running, insider trading, plain cheating of investors, where there's, again, enough evidence that a special UPI is not what is going to save people. It helps, but it's not really a solution. So what it really does is impose another layer of compliance and procedural burden on those who are already registered. Some of them may be clean, running very clean businesses. That's not all. SEBI now wants them to conduct investor awareness programs through SMS, email, social media posts, and what have you. Now, who will they communicate to? They are not large entities who can communicate to the world or issue advertisements. They will give it to their same circle, people who are registered with them, because that's their reach. How does it help? We don't know. But since it becomes mandatory, it imposes another additional cost. Now, investor awareness campaigns, if you ask me, ought to be the regulator's responsibility. The RBI can get Amitabh Bachchan because it has huge funds in the Investor Protection Fund, Depositor Education and Protection Fund. SEBI has an Investor Protection Fund. Ministry of Company Affairs has one. Use that money. It should not be intermediaries who are cracked the whip and made to send out these posts. It costs money. Even making a mailer costs money, needs a person, and needs a mailing cost. Isn't it ironical that while SEBI intends to impose additional costs on registered intermediaries, all the dodgy actors, fraudsters, influencers continue to operate with absolute impunity? And why am I saying it? Just recently, SEBI issued an action against Ketan Parekh. Who's Ketan Parekh? Close buddy of Harshad Mehta of 1992 scam, the central figure of the 2000 scam, where he himself brought the entire market crashing. A joint parliamentary committee was set up. He was banned from the market for 14 years. Within those 14 years, he broke that ban and was caught again by SEBI. And now he's been caught all over again in Jan, the intermediate order for front running. And with whom? With a whole bunch of people from Calcutta and elsewhere in the country who were again involved in his previous scam. So the same people are operating in impunity. Nothing works. No KYC, no registration, no green thumbs, nothing. Meanwhile, foolish or greedy investors will continue to invest in unregistered entities. There's another segment which prefers unregistered intermediaries and deliberately invest in this thriving dabba trading, or what is a pure cash market based on transactions in the legitimate market. These are people who want to deploy black money, tax evasion, corruption, political funding. Well-known fund managers who are appearing on TV, pumping up stocks, nothing will be found in their official books, because all this is done in the dabba market and they're making money. There are whistleblowers writing to me, sending me videos to say how this happens. SEBI is unaware. SEBI will make rules for registered entities. In fact, SEBI knows the modus operandi of this whole dabba market, because if you read the Ketan Parekh order issued very recently, then SEBI even has diagrams, notes. It knows exactly how money changes, the extent to which cash changes hands, comes through Angadias. So why is there no serious effort to crack down on this completely illegal and thriving market? Maybe because people are so politically powerful and part of the government, because corrupt people have to put their money somewhere, right? And it has to be all cash. They're not operating in the official market at all. In mid 2024, SEBI issued new rules for registered investment advisors. I'm saying this now to say how SEBI keeps whipping registered people until they're getting out of business. So it dealt such a blow to the community. First, to investment advisors, then research analysts. Okay. It says that they have to submit themselves to onerous audits, compliances, which are completely out of line with their revenue. They need special compliance officers. Worse, SEBI says they can only collect their fees every quarter. Now, almost all business papers have written about it because this was such a blow that instead of helping, protecting, or saving anyone, the best registered investment advisors who are running a clean business just decided to shut shop and go public with it, saying, we can't run this business anymore. And several others are contemplating closing. It's also happened right now. Even while that is happening, people are shutting shop. It's not that the top SEBI brass doesn't know about it. They're coming up with yet another consultation paper. In fact, top SEBI officials have informally said that they agree that it was a bit much, reached breaking point. But they've done nothing about it because there's no pressure on the regulator to act. You can shut your business down. You can be deprived of a good advisor, but the regulator will take its own sweet time when it comes to this. If you ask me, if SEBI were to engage with investors, it would learn that most of them would prefer to have access to good advisors at a reasonable cost. They would prefer to be able to access a good PMS with a lower entry rather than making sachets for mutual funds, right? So UPI and the green thumb is essentially a gimmick. It's good, it helps, it's not necessary. If it's optional, it's all right. The minute it's mandatory, it kills the ease of doing business. And ease of doing business is a mantra that this government has been chanting for so many years and has been reiterated by the Economic Survey 2025, which is 2 days from the time SEBI came up with this consultation paper. What did the Economic Survey say? It says or suggests sweeping regulatory reforms and warns that excessive compliance burdens are hindering the formalization of business, stifling job creation, and slowing down the growth of the economy. Yes, it has reached breaking point at the larger economy level, not just this. In fact, the survey specifically exhorts the government to get out of the way and allow businesses to focus on their core mission. It wants regulators to change the operating principle of regulations from guilty until proven innocent to innocent until proven guilty, which means don't keep whipping people who have been stupid enough to get regulated by you instead of operating in the dabba market. What the Economic Survey says, and I'm quoting, is adding layers of operational conditions to policies to prevent abuse, in fact, makes them incomprehensible and regulations needlessly complicated, taking them further from their original purpose and intents. SEBI's proposal is completely out of sync with this suggestion. In fact, SEBI's propensity to dream up new layers of compliance for regulated entities has reached such a breaking point that an article by Advocate Sandeep Parekh, who used to be an executive director in SEBI, went viral. Why? Because he pointed out how SEBI's regulations and laws are so full of enormous verbiage. One law alone on unfair trade practices is 24,000 words, while the comparative law in the US is just a few thousand or just above 1,000. He writes that these laws, so extensive, deeming provisions, cause harm to innocent people and let the guilty go free. In fact, I've myself written several columns and video blogs pointing out how SEBI has prosecuted and hounded people over multiple levels of appeal, goes to SAT, goes to the Supreme Court, based on not just ill-conceived regulation, but an ill-conceived understanding of its own regulation. If the Economic Survey has to be more than an inconsequential pre-budget formality, then let's start taking it seriously. The Finance Ministry needs to ensure that its ideas are actually implemented on the ground. So let's start with the regulator because it's doing damage. If you agree, then make your voice heard because this is a consultation paper and you can write and tell SEBI whether you want a green thumbs up or you want better, cleaner, more honest intermediaries. Thank you. And if you haven't yet subscribed, please do subscribe.